Today's Talk About It Tuesday question is, some people say that you should pay extra money every month to try and pay off your mortgage as soon as possible, while others say you should never pay off your mortgage. What are the advantages and disadvantages of paying off your mortgage early? That is a huge debate, and I'm going to show you both sides of this, but I'm going to assume that the person is talking about a mortgage on your home, not on a rental property, because totally different strategy. So just to get the rental property out of the way, I would never, ever, ever pay off a mortgage on a rental property as long as the rent coming in can service the debt, meaning that you have more than enough rental income coming in to cover the debt. Why leave the equity in the walls? It doesn't serve you there. I would refinance as much as possible, again, leaving a little cushion in case you lose a tenant or somebody can't pay, so that the rent can cover the cost of borrowing, take the money and leverage it to get other assets, whether it's more real estate or stocks or anything else. And I would borrow my way to a higher net worth. And I would keep doing that. When it gets paid down, again, I would refinance, pull that equity out, as many times as I could, as long as I said that the rental income can cover the cost of doing so. But we're talking about a primary residence in this case, which is totally different because we don't have rental income coming in to service the debt. So let's talk about why you hear most people say you should pay off your mortgage early. And it makes a lot of sense, but we're going to give both sides of it. So one is peace of mind, right? People say they don't like carrying a debt. Emotionally, it makes them feel better to be debt free. And so they want to pay it off. The other part of that is that if they consider down the road the fear of somehow they get an interruption in their income, whether it's loss of a job or loss of the ability to work, right? They become disabled, or economic downturn, or any reason that they might have a loss of income in the future, the fear of not being able to pay the mortgage at that time and running the risk of going into foreclosure, they want to mitigate the risk of going into foreclosure. The third reason you tend to hear people say pay off your mortgage early is the savings you get in terms of interest payments. So what most people don't realize is the interest on an amortized mortgage, right? Meaning it's not strict payments. Most of the interest is paid up front in the early years, and the latter years is less interest paid and more principal paid. So in the beginning, it's stacked with interest, and you're paying that down on usually a 30-year mortgage or a 20-year mortgage. 30 years for most people. It's mostly interest, and then it becomes mostly principal as you've paid down most of the interest. So there's this idea that if you pay more towards the principal early, then you will save in the back end on interest payments. You'll save thousands of dollars, which you will. You'll save thousands of dollars. So now let's look at the broader picture. So if you're paying extra money towards the mortgage and that money is going into the walls of the property, basically, what is the opportunity cost? What is the opportunity cost of paying the extra money into the property as opposed to having the liquidity to do something else with it? So if we do some simple math, depending on the interest rate on your mortgage, and most people have a pretty decent interest rate. Interest rates haven't been high in a long time. But let's say you get 5.5 or less. Equities, meaning the stock market, has outperformed that number forever. So if we look at just 20 years or 30 years, the length of your mortgage, we're talking about an 11% average gain annual in the stock market. So that means you don't have money to put in the stock market because you're putting it in the walls to service a debt that might be 4.5%, 5%. Whereas had you taken that same money and put it into the stock market at 11%, you would end up net positive, as opposed to if you had a higher, interest debt that outpaced the performance of equities, then it would make more sense. But you're giving up, and we got to remember with the stock market, it's time in, not timing, meaning we are relying on compounded growth. So the sooner you had it in, the more money you're going to make on the back end because of compounding. So you're giving up this ability to invest and get compounded growth to try to service a debt sooner. And when you look probably at what you saved in interest by doing so, you gave up a whole lot more on the other side of that. So there's an opportunity cost in doing that. There's less liquidity for every and anything in that regard. So when you're talking about potential emergencies or money for things that you need, like maybe a new car or all these other things, you don't have the liquid cash, and you're going to be forced to either borrow or sell something at the same time. So you give up you give up liquidity, you give up time in the market. You also have to consider taxes. So a lot of people rely on the interest deduction, mortgage interest deduction on their taxes. You pay it off early, you're giving that up too. So you have to consider whether or not that's important to you. For some people, it's not important. For some people, it is. You also have to consider, so we always look at inflation as a bad thing. And what is inflation? Inflation means the reduction in purchasing power of the dollar, right? Inflation actually works on your side when you stretch a debt out. And you're like, what? Inflation actually works in your favor when you stretch a debt out longer, because now you have a fixed, if it's a fixed, not variable, right? If you have a fixed amount, let's say it's $1,000, I just use that as an easy number. Your mortgage payment is $1,000. $1,000 in the year 2000 had greater purchasing power than it does today, and it has greater purchasing power today than it will have in another 10 years, which means you're paying off the same debt with a weaker dollar in the future. So in that regard, inflation works in your favor by stretching the debt out because you're using a weaker dollar to pay off a debt you made with a stronger dollar at that time. And that's a little weird in terms of the math for some people, but think about it. What you can purchase today for $1 is totally different than what you could purchase 20 years ago for $1. You can get a lot more a long time ago. So you're paying off a debt with a weaker dollar. Yeah, I think so. When you put it on a scale, you have to decide, do I want to give up the opportunity cost in terms of putting it in a home versus putting it in investments, especially when I do the math, when stocks tend to outperform the equity growth and certainly outperform the interest rate on a mortgage. So equity in a property doesn't grow as fast as equities, meaning stocks. You tend to get a better value here, especially if you do something simple like an index fund instead of picking your own stocks. You give up the tax advantage. You give up. There's so many things you give up. I don't know if it's advantageous, and it depends on your age too. I think if you're a little older and you have a shorter time horizon, and you fear that you're unable to make the payments down the road and you'd be forced to lose your home, then it might be something to consider to pay it off. But the other part of that is, if you're dumping extra money, that means you're not creating a cash reserve for yourself that you might need. And then you'd be forced to probably sell the home because borrowing against it becomes more difficult when you're older. So when you put it on the scale, I think there are more advantages to not paying it off than there are to paying it off early. That peace of mind versus getting richer. I think growing wealth gives you a better peace of mind than paying off a debt early, and then tying your money up in something. And the only way to extract it is to either borrow again or sell it, right? So that's the only way you can extract that money back out of the property, is to either borrow again and start a whole new debt, and you don't know what interest you're going to get, or if you even qualify for it at the time, or sell the asset. So as opposed to doing that, if you have a very low interest mortgage, I say don't pay it off early. Take that extra money that you would have dumped in there and put it in something that's going to give you a greater return than the cost of the debt. So those are my thoughts. I'd love to hear your thoughts. Would you pay it off early, or would you take that extra money you were going to put there and put it somewhere else where it's going to make money? And again, you have to be a disciplined investor. If you're going to not, pay it off and then just spend it on something silly, then of course you lose all the way around. But those are my thoughts. I'd love to hear your thoughts. Please like, share, subscribe. Keep the questions coming, and I'll see you next Tuesday.